Hey guys, congratulations. If you're watching this video, that means you are most likely already a subscriber to our long-term alerts or VIP alerts. If we decide to post this video on YouTube, it is in the hopes that if you're not a subscriber, you could still apply some of these strategies in your day-to-day trading or swing trading, and hopefully it's going to help you manage and execute your trades better as well. So if you're a subscriber to the VIP alerts or long-term alerts, congratulations, okay? Before you place any trades, we're going to review the 8 basic key things. They're simple things, but it is important that you fully understand them and that you do not take any trades based on any alerts until you have full clarity on what these 8 key things are. So here's rule number 1. Never put all of your eggs in one basket. We'd like to think of it as a 5% rule. Now, the 5% rule may be a little bit difficult to implement if your account is only $1,000 or $2,000. So in those cases, you may have to consider going to maybe 10, 15%. But especially if you're day trading, right? Do not allocate more than 5 to 15% of your trading account towards any given trade at any point in time. In other words, it's a sure recipe for disaster if you sink, your whole trading account in a particular trade that you really, really love and you think the world of, and then that trade does not work out for whatever reason. So to quantify, here's an example. If your account is $20K, don't allocate more than $1,000 to $2,000 towards any particular trade. And you will probably have the tendency, if you have a $20,000 account, this is what a typical trader wants to do. Well, I'm not sure about these alerts, so I'll go ahead and put 1,000 in this one. Oh man, I really like this one here. This is my kind of trade. Oh yeah, Leonardo, I like this one, so this is what I'm going to do. I'm going to put 10 grand in this one. Guys, it's not about hitting a home run and getting rich overnight. It's about, think of this from the standpoint of taking 10 trades. And our goal is to make sure that you're getting more than half of these trades correctly, that you're generating income, you're generating profits on more than half of these trades. So based on the profit targets that we have, we target returns of 200, 300%. If you get more than 52% of these trades correctly executed and you manage them well, your account will grow if you follow all the other rules that are laid out here. So don't allocate more than $1,000, $2,000 towards any given trade. Never put all or half of your account into any given trade, no matter how much you are in love with the trade. Rule number 2, don't buy all in one shot. And this is what we mean. Sometimes a trader gets an alert, gets really excited about the idea, and like, oh, okay, so I've allocated 2 grand, based off my account size, that's 5%. I'm just going to go ahead, boom, buy 2 grand right now, all in, 20 calls, 20 puts, or whatever the case may be. Well, slow down, Tiger. Not so fast. If you want to maximize your results, we absolutely are in favor of sticking to the stair-step strategy when it comes to opening your positions and when it comes to closing your positions. Okay, just think about what these big institutional investors are doing. Do you think they just decide, we'll buy 100 million of Apple shares today? No, they don't do that, okay? They don't open all of their positions on the same day at the same time. Do you think Warren Buffett bought all the Apple shares in one day? No, he bought some initially. You watch how his investment worked for him. Then he added more later, and then he added more again, and then he added more again. In other words, he took steps. He stair-stepped into building his positions. Now, when we're talking about this from the standpoint of day trading or swing trading, we're not waiting 6 months to add more to the position. I mean, you could be opening the position at 9:30 in the morning. You could be adding to it by 10 o'clock. But the point here is this. Buy the first half that you allocated towards the trade. So if your allocation is $2,000 per trade, then first go ahead and utilize the $1,000. Or, and then watch the trade and decide later whether you want to add to the position or whether you want to cut the position. And so here's an example. So let's say your full allocation is $1,000 towards any given trade. Okay, so you can buy, let's assume that you're buying calls and they're each worth about $1. So basically for $500, you would be spending half of what you have allocated in advance. And again, the key here is you're going to make a decision about this in advance. How much are you going to spend on a trade? And when you know what that amount is, in this case, it's $1,000, you're not just going to go ahead and spend the whole $1,000 all in one shot. What you're going to do is you're going to buy 5 calls at $1, which is going to be $500. And then you're going to watch the position. And at that point, it's going to give you the ability to either add at a better price, or it's going to give you the ability to minimize your loss. Clearly, if you're jumping with $1,000 all at once and the trade does not go as planned, then your losses is going to be greater than if you just initially invest only $500. Pretty basic stuff here, guys. Two things will take place after you initiate the first trade. And here's the 2 possible variations. You will start losing money pretty much right away. And option 2, you will start making money pretty much right away. And that's what typically happens. Now, this particular strategy, again, we're trading weekly options. So the values on these options, they change rapidly. They change literally minute by minute. Within 10 minutes, I mean, your option value could double. And so it could diminish just as fast. So it's important not to jump in all in one shot. And you're going to see in your trading account how you're either going to start materializing losses or materializing gains. But again, the key is to determine in advance what are you going to do. So if you only allocate half of the capital that you've predetermined in advance that you're going to put towards any given trade, then by not jumping all in once, you're going to minimize your losses. And if you minimize your losses and maximize gains, your account will grow. It's that simple, guys, okay? So this is what you're going to do. If you start losing money, you will have a choice, okay? You will be able to add more at a better price. So in other words, if you're looking at the stock that's $100 a share, and you basically making a bullish bet here that is going to go to 105, maybe you're buying 100 calls or 101 calls or whatever. What if the stock drops to, let's say, $98 or $97? Well, at that point, you can completely get out of those 5 calls, or you can add 5 more calls at a better price. Now, why would you want to do that? Well, if everything stays still, as far as your strategy, as far as your analysis, as far as, everything with the alert that you're getting, in other words, you're not seeing any messages coming out, oh, hey, you need to get out of this trade. Something clearly foundationally changed about the reason why we were taking the trade and why we were taking the alert. If you're not noticing any signs like this, then you can scale into the trade at a better cost. If you jump out all at once, right, you don't have the luxury to make that sort of decision because you've already utilized all the capital that you've allocated to the trade. So again, your options are you can cut the small loss or you can add to the position at a better price if the theory behind the trade still stays the same. In other words, as a trader, you're not going to be able to nail a perfect entry each and every time. And sometimes we're actually really good at that. And we nail it right on the dollar amount down to, pennies and cents, okay? So, but it's impossible to do it each and every time. So by scaling in and protecting yourself, you will do much, much better. Okay, so say if you jump all in at once, again, you don't have the luxury to make the decision to add at a better price. By initially scaling to positions, you're giving yourself options to manage the trade to your advantage. And so clearly, if you jump all in and the trade starts going against you, what do you think is going to take place? Well, your losses will build up fast. At that point, when somebody's losses, I'm talking about generally a trader that, opened the position, all of a sudden the position starts going against them. Guess what do they do? Because of the size of the losses, they're having a very hard time parting with the trade. It's a very common mistake, right? You want to cut your losses if something changes theoretically with the trade. Let's say we're buying puts and all of a sudden there's an announcement that there's a takeover, potential takeover. Well, clearly the stock is not going to drop on such news. It's going to go higher. So that would be clearly a reason to completely get out of the trade as soon as you can, right? That's not going to happen very often, but still, you have to consider the possibility of that taking place. Most of the traders, when they start realizing some big losses on their position, they don't cut the losses. They actually have a tendency to stay with the losses. If initially you scale in with a small position, you have the luxury to make a decision, a management decision, to cut the position when the losses are small. Now, if everything looks good, or maybe now, besides the 5 typical things that we analyze in favor of taking the trade, maybe we've added that 6th or 7th thing that clearly it makes sense to add to the position rather than cut the loss. That's going to give you the ability to get out of the position at a much better time without realizing big losses. Very important, guys. Here's how the alert is going to look on your phone screen. Like, it's going to show something like this. Okay, Amazon, 1650 calls at 5.5. Current price, 1630. Target, 1680. So that tells you the current price of Amazon is 1630. Our target price, and since we're trading weekly options, our target price is going to be based for what we believe the stock will trade at some point this week. So the target price would be $1,680. Okay, the current cost of these options, the 1650s, okay, are 5.5. So for one option at 5.5, you would be spending $550. Let's take a further look. What action would you take on this alert? So if you're a new subscriber to the alerts, you may be like, oh, I love this trade, man. Let me, I got 100 grand in my account. Let me go ahead and put 30 grand in this trade. No. Okay, remember the 5 to 15% rule. And actually, we're going to just take a step further. So when you get in this, what we want you to do, right, whatever that amount you have allocated to your trade, and in this case, we're going to use that example of $1,000. So if you allocated $1,000 towards this trade, then the step 1 to execute this alert would be to buy one call of Amazon when it trades right at or around $1,630. Now, by the time you actually receiving the alert, I mean, it could be $1. I mean, Amazon moves quite a bit, right? On certain days, it can move $50. So clearly, if it's already trading at $1,650, it's probably too late to take the trade. But if you're getting this and the price is around $1,630, maybe $1,629, $1,631, $1,632, then the option price is pretty much going to be right around there. It could be 5.3, 5.7, right? But if something substantially changed by the time you're getting the alert, it's probably too late to be getting into the trade. You're taking that trade. So far, you've invested $550 by buying one call option. 30 minutes later, this is what happens. The price drops to $1,615. What is your action? Now you're going to have possible scenarios. Now you're looking to take step 2. Step 2 of executing the alert would be this. You have option 1. Let's say we're observing that the entire market, maybe some crazy news came out of China. Maybe another crazy Trump tweet that all of a sudden all the indices, all the markets are reversing. Everything is just starting to go to hell. Okay, so at that point you may consider cutting losses. But if nothing changed, right, and the market is in a bullish trend, it's making sort of a pullback, okay, then you probably going to execute option 2. Option 2 would be buy one more Amazon call at this point at 3.5. When the price of Amazon is $1,615. That would actually give you an opportunity to buy those 1650 calls at a better price. Now, the total cost on both options now would be $900. If you would have bought them all in one shot, your total cost would have been $1,100, and you would have already had a much more significant loss. So you might have been tempted to get out of the trade, what could actually be a very successful trade. So here's the next case scenario. Amazon price next day goes to $1,670. Remember, now you own 2 contracts. What is your action? The answer is this. sell half and keep half. Remember, you never want to just buy one contract. You want to buy a multiple of 2. Why? In other words, you could buy 2, 4, 6, 10, something that's divisible by 2 really easily. So in this case, the idea is this. You want to sell half and keep half. Well, hold on. The stock went up $40 since you bought it. Don't you just want to lock in gains? No, guys. And I'm going to go a little bit further into explaining that in just a second. Just remember, when the profits are starting to go your way, your market is telling you you are on the right track. But you don't want to cut your whole position. What you want to do is sell, in this particular example, you want to sell one call and you want to keep the other call. So to finish this particular example, step 3, Amazon goes later that day to $1,690. What do you do at that point? You close the other call. So you first you close the first one at $1,670. You close the second one at $1,690. Very, very important, guys. So you sell the second half of the position when the stock continues to go higher to $1,690. Going back to step 2, right? So you bought one Amazon call when you got the alert. It goes at 3.5. Now you got $900 invested into the trade total. Whoa, what about this? Holy, certainly didn't. Oh boy. Now the Amazon price, instead of going higher, it actually drops to $1,610. What is your action? Well, your action is clearly you can sell both of the call options and completely get out and realize a small loss. And why do I emphasize the small loss? Well, because you stair-stepped into the trade because you didn't jump all out at once. You have the luxury of minimizing your losses because if you would have jumped all at once and the trade went against you, your losses would have been substantially higher. Or if nothing else changes, right? Because Amazon could drop $20 and go $30 in the next half an hour, right? It's just $15 drop for Amazon is really not that big of a deal. So if the theory behind the trade still stays intact, what you may want to do is you want to may add again. Now, you can sell half and keep half. Just remember, if you are in doubt, if you're ever in doubt what to do with your position, the basic simplest thing you can do that I promise you're not going to regret about is sell half, keep half. It works well when the position is going against you, and it works well when the position is going in your favor. By actually focusing on selling half and keeping half, let's say the trade goes against you. You got 2 contracts. Selling one contract, what do? You minimize your losses. By keeping the other contract, okay, if nothing really jeopardizes the trade still, you just get a little uncomfortable with realizing a bigger loss, you still got the position, you still got half of the position. If reverses goes higher, as it often does, hey, you can still make, not just for the small loss that you just recently took on that, you can make a substantially higher gain on just one contract. But it's going to take a lot of stress out of the equation. Just sell half and keep half. Remember, if the position goes against you, what's the easiest thing to do? Sell half, keep half. If the position is going your way and now you're starting to see some gains, what's the easiest thing to do? Sell half, keep half. Guys, if you use this simple rule, you'll never regret about it. I promise you, it works like magic, okay? So the same thing is actually, that's the point 3, right? The point 3 is don't sell all in one shot. Always sell half and keep half for more gains. So let the profits run. So in other words, a lot of traders, they struggle with figuring out, well, what's the best time to sell? What's the best, how do I nail the top? How do I do this? Well, it's humanly impossible to nail the top each and every time. But just think about this like this, okay? How will you ever lock in a 300% gain if you're out of your entire position at 50% gain? So wouldn't it make sense to just sell one by the time you say realize a 50% gain? Generally, for our VIP subscribers, we suggest, because of the strategies that would you utilize, starting taking gains at about 250, 280, 300% in that range. And a lot of it has to do with the VIX environment. So generally speaking, the higher the VIX, and if the VIX is an uptrend, you actually want to give yourself some leeway and increase some of these targets. If the VIX is like low, between 11 and 12 and 13, then you need to cut these profit targets significantly lower, maybe to like 100, 150% gains on some of these options. We'll look at the environment, but in the chat room, we're actually going to specify every morning. Some of these alerts and market analysis, they start going out as early as 4 or 5 in the morning at times to kind of let you know what happened in the overseas market, what's going on here, what's going on here. And so it kind of lets you know what we're thinking that day overall is the strategy. And then later, you start receiving specific alerts on specific stocks. Just think about it. Again, how will you ever lock in a 200% gain if you cut in the whole position at 20%? How will you ever make 1,000% returns? And yes, without alerts, I've had many traders, okay, on many occasions, locking gains over 1,000% on some of these trades, guys. We actually had some cases where we locked in over 2,000% of some of these trades. So how do you ever lock in 1,000 or 2,000% gain if you're already out of your position, out of the entire position, when it's hitting 50% first target? Just keep that in mind. Sell half, keep half, and that's how you will be able to allow your profits to run higher. Okay, number 4 is crucial, guys. Especially the new subscribers, okay, when they start getting these alerts. Look, there's 3 of us here, and all of us have some great ideas on, both the short side and the call side, and, overall, we want to send these alerts out. So you don't have to take advantage of every alert. It's simply impossible, right? Because some days you'll have 2, 3 alerts. Some days you're going to have 10, 12. Well, I don't expect anyone to take all 10 or 12 alerts. That would be just humanly impossible. Not humanly impossible to actually get into the trades, but would be humanly impossible to actually manage them well. Here's the general rule of thumb. I don't want anyone to be in more than 3 or 4 trades at any given time. So here's what I'd rather have you do. It's better to focus on managing a few trades successfully than mismanaging a bunch of trades. Look, we are traders here. We trade weekly options. They're instruments that move very, very fast. So if you got too many trades, you're going to be stressed out. We don't want you to be stressed out. We want you to focus on just a handful of trades and want you to focus on managing them, scaling in, scaling out, not jumping in all at once in these positions, understanding how much of your total portfolio you should be utilizing towards any trade, minimizing risk, minimizing losses, letting the profits run when the trades are starting to build and go in your direction, when the market is telling you you're right. It makes sense to steer step out of your positions. I actually have a whole course that we have specifically broken down on exiting when I've set a personal record of taking 12K to 466K. Okay, that course is an hour course, and about 15 minutes of that course I spent specifically on showing what has contributed to such a tremendous success, and that was being able to scale out of the trades at the right times. And how did I do it? Well, by utilizing this simple approach. So if you have not taken that course yet, by the way, 12K to 466K, it's highly recommended. If you are a day trader, if you're a swing trader, that course will help you tremendously to increase your profits. So minimize losses, let your profits run. That's how you grow your account. Better to focus on managing just a few trades successfully than mismanaging a bunch of trades. What we want you to do is focus on execution, scale in, scale out of those few trades. Number 5, never open all of those 3 or 4 trades at the same time. See, the idea is this. What if you're getting into a good trade that temporarily could go bad, and the next day it could reverse and it go in your direction? It's okay if you got 1 trade like that. What if you got 3 or 4 trades that you've opened at the same time? Something unexpected happens. All of a sudden, the market starts reversing completely, and nobody has calculated that. Okay, because it's something unseen, like a black swan event of some kind, right? So what do? You can persevere and handle your positions. and hold on to them if you only got one trade. But can you imagine if you got 3 or 4 or more? What's going to happen? You're going to panic. You're going to get stressed out. You're going to get worried. You're going to get fearful, and that's when you're going to make the worst decision. You're going to get out. And you're not going to get out of just one. You're going to get out of all of them because you're going to be so freaking scared. That's typically the worst decision you can make. If you are taking trades, let's say you take and you get into one trade in the morning between, let's say 9:45 and 10 o'clock. You let the trade grow. You see what's actually happening for the next few hours. Then you may want to consider taking another trade, let's say at 2:30 or 3:30 in the afternoon. The next day, you may want to open your third trade. The whole key point here, guys, is this. Don't just jump out at 9:30 in the morning when the market looks like it's going higher and take 3 or 4 trades all at the same time. No, you don't want to do that because, again, if the market does something completely unexpected, which a lot of times it does reverse by 10:15 in the morning, if it's like a market move too, then you don't want to get caught with a bunch of trades on the call side all at once. Be very, very careful. Do not open a bunch of trades at the same moment in time during that trading day. Some news could come out unexpectedly, a black swan event. It could put you in really bad stuff. Guys, just don't do it. Point 6. If you don't understand the trade, look, let's just agree on this right now. If you don't understand the trade, just don't take the trade. Don't take the trade until you understand why we're taking the trade. All right, and clearly as a VIP, you can reach out to us, ask questions. Okay, part of the VIP program, we'll get on the phone with you at some point in the day. We'll review some of your position. We'll review some of the trades. This is what the VIP service is about. So if you don't understand the trade, gain more understanding about the trade, just don't take it. We'd rather have you not take the trade. And here's why. If you don't understand the trade, it will damage your ability to execute and manage the trade successfully. It's just better not to take it until you get clarity of why the trade is being taken in the first place. Rule 7, don't trade if you can't focus. For example, if you're traveling, you got a bunch of business owners that own a few businesses. Hey, you guys travel all the time, so what's the best thing to do when you're traveling? Don't open big positions, okay? So, if you're swing trading on those trips while you're gone for a few days or a week, okay, and you're not sitting at your regular set in your office, with a few screens and so on. Well, it's the best thing to do is just not trade or just take small positions, because if you're going to have huge position in those days with your travel, you got a bunch of important meetings going on, look, your mind is not going to be in trading. And chances are you're going to miss out on some really good exits, and chances are you're going to miss out on some good entries. So just don't do it. Just clear your mind, focus on your meetings, focus on the travel, so you don't have to be stressed out. If you really, really insist on taking a trade, instead of buying 50 contracts, buy 5. You can relax on that flight. You don't have to be worried. Oh, gee, I wonder, how's my position going? And you're like on a 3-hour flight from New York to Seattle. Just don't do it. All right, and the last and most important thing, okay? As soon as you open the trade, set the limit orders to close out the positions at different price levels as soon as you open them. Do not forget to do this. And going back, look, guys, I'll give you a very good example. I've had a trader that was taking a flight, and his flight was at 9 in the morning. So it was before the markets opened up, and pre-market, everything was dropping. He had some Netflix puts. And he got on the flight. The market was doing beautifully. And so he had about 30 or 40 Netflix puts. Netflix dropped like, $30 while he was in the air. And for about an hour, the market continued to drop after the market opened. Well, I told him before he got on the plane, don't forget to set the limit orders. But he got tied up. He got busy. He forgot. So guess what? He was making about $50,000, $60,000 on that position. But by the time he actually landed, the market by that point already reversed, and Netflix shot way higher. As a matter of fact, it was such a huge bullish reversal that by the time he landed, instead of making 50, 60 grand, he was losing 10, 15,000. The markets, guys, they can be brutal. And the only way you can protect yourself, again, especially you're trading, don't open big positions, number one. But number two, always set the limit orders, even if you're not traveling. Set the limit orders. So in other words, you want to, per hour alerts, as you can see, there is a target price. Like in the case of Amazon, in the example we were using earlier, 1,680. Well, the target price is just kind of a guide. It doesn't necessarily mean, oh, we don't touch the position until it hits 1,680. No, if it gets in the range of maybe 1675 and it looks like it's hesitant to move higher and it tries to break for that level a few times, look, sell half, keep half. But you got to understand what your option roughly is going to be valued if your stock is going to get to that level, so you can set the limit order in advance. And again, you don't want to sell the entire position because maybe that hesitation to move higher is just temporary. So you want to set maybe one order to sell half of the position at 18.5, and you want to set the other limit order to sell half of the position at 26.5. Okay, so if you're on the plane, like in that particular example, if he was on an airplane and the market had this crazy reversal, if he would have set his limit orders, by the time he landed, it would have been 50, 60 K positive in his account, because those orders would have definitely worked based off the prices based off our target prices on Netflix that day. So very important. Again, even if you're not traveling, what do you guys want to do? The moment you open the trade, what do you want to do? You want to set a limit order. How do you set the limit order? And how do you know what it's going to be worth? Well, based off the target price, you can calculate what your option is going to be worth. And look, if you're trading like 3 months options and 6 months, there's a lot of premium added on top of the actual intrinsic value. When we trade weekly options, it's pretty much you take the price. Let's say if we're trading puts, you take the price of the stock and you subtract it from your strike price, and that's what your option is going to be worth. So let's say you're buying Amazon puts, 1,700 puts, and then the Amazon target price is $1,660 on the way lower. So the 1,700 puts on Amazon would be worth at least $40 if it hits a level of 1,660. And guys, if you're new and you just joined the alerts and you don't understand how to do that, look, it's okay. If you're a VIP, you can reach out with some of these questions. We can help you set those limit orders in there. We can go through that a few times. We'll hold your hand so you can actually understand what is the appropriate action to take, how to set those limit orders. Point 8 is so important, guys, because if you don't do that, look, sometimes markets are slow. The VIX is moving slow. There's no fear in the market. Well, how about months like February 2018? When the markets were going down 1,000, 2,000 points. See, many people don't understand. It can happen at any moment. So what do? If you want to get the best prices for your options, you want to have those limit orders sitting there. So if the move lower is going to come like a hurricane, you're going to get the best fill prices on these limit orders. Again, before you start the day. This is what I want you to do. Before you even go, look. Before you even have breakfast, before you even go take a shower, look at your screen and set these limit orders before you're going to get busy with everything else you got to do that day, before the life gets a hold of you. So make sure that's the first thing you do in the morning. I want you to reset those limit orders every day, depending whether the trade is proceeding to go our way, whether the trade is stalling, whether the market is telling us we're right, we're wrong, and so on. So before you do anything else that morning, I want you to readjust those limit orders according to any changes that could impact our strategy or the price targets, okay, that day. So every morning, the first thing you do on your open positions is you set and adjust the limit orders to what makes sense that day. Okay, guys, look, these are the key things. And if you stick to them and you actually manage and execute your trades, again, remember, you don't have to trade and jump on every alert. You will do much better if you just focus on executing. We said 3 or 4 trades. Look, you can just focus on executing 2 trades. And I promise you will be much better off because you will be scaling, you will be scaling out, you will be focused on setting your limit orders, adjusting the limit orders. Guys, the sky is the limit if you do this right. So congratulations on signing up for the alerts. If you haven't, and this video is somewhere out there, chances are there's a link below this video somewhere where you can sign up. Just remember, we do not allow people to sign up for the alerts unless you've taken the chart course, the 13 market moves course, and so on. So make sure you do that first. With that being said, I look forward to your huge success in trading stocks and options. I look forward to you sharing your success story at some point on this channel.